Most people hear the word recession and immediately feel fear. They tighten their wallets, stop investing, and wait for the storm to pass. But there is a small group of people who do the exact opposite. They lean in, they buy, they build. And when the economy recovers, they emerge with more wealth than they ever imagined. The uncomfortable truth is this: more millionaires are created during economic downturns than at any other time. So the real question is not whether a recession will come. It always does. The real question is, which side of it will you be standing on? The hidden pattern behind every economic cycle: the economy does not move in a straight line. It breathes, it expands, contracts, recovers, and grows again. This rhythm is called the economic cycle, and it has 4 distinct phases: expansion, peak, recession, and recovery. Every single decade in modern American history has seen at least one recession. Since World War II, the average contraction has lasted roughly 11 months. But here is the part most people miss: the expansion phases that follow typically last around 58 months. That means for every one bad year, there are nearly 5 good ones waiting on the other side. Understanding this pattern is the foundation of generational wealth. During the expansion phase, asset prices climb, employment rises, businesses grow. Most people spend more and save less. Then the peak arrives, where everything looks perfect on the surface, but the cracks are already forming underneath. Then comes the contraction. Panic sets in. Markets fall. Jobs disappear. Asset prices collapse. And finally, the recovery begins, quietly at first, and then explosively. Warren Buffett has lived through this cycle many times over. His entire investment philosophy is built on understanding it deeply. While most investors fled the market during the 2008 financial crisis, Buffett moved aggressively in the opposite direction. He purchased hundreds of millions in preferred stock from Goldman Sachs and General Electric at 10% interest rates. Those strategic bets had returned over $10 billion in profit. His now famous advice captures the strategy perfectly: be fearful when others are greedy, and greedy when others are fearful. He did not stumble into wealth. He understood the cycle and positioned himself before the crowd caught on. The same pattern played out during the Great Depression of the 1930s. Michael J. Cullen, while the rest of America was drowning in economic misery, launched the first modern supermarket, King Kullen. Cullen recognized that struggling consumers needed low prices and convenience more than ever. He built his store outside city centers, where rent was cheap, and stocked it with everything a household needed under one roof. While others saw a collapsing economy, Cullen saw an underserved market. That single decision turned economic devastation into entrepreneurial legacy. Why recessions are the greatest wealth transfer events in history. Here is what most financial textbooks do not teach. Recessions do not destroy wealth. They redistribute it. They move money from those who are unprepared, emotionally reactive, and over-leveraged, directly into the hands of those who are patient, financially educated, and strategically positioned. During downturns, asset prices fall dramatically. Stocks trade at deep discounts. Real estate properties become available at a fraction of their peak value. Businesses that took decades to build suddenly become acquirable at bargain prices. For those with liquidity and vision, this is not a crisis, it is a clearance sale. The 2008 financial crisis is perhaps the most powerful modern example of this wealth transfer. While millions of homeowners were losing their properties to foreclosure, a new wave of real estate investors was quietly scooping up those same properties at historically low prices. When the market recovered over the following decade, many of those early buyers saw their investments multiply several times over. The S&P 500 alone doubled in value within 5 years of the crisis. Those who stayed invested or bought more during the fear were rewarded enormously. Travis Kalanick and Garrett Camp launched Uber in 2009, right in the middle of the economic wreckage. Brian Chesky and his co-founders built Airbnb during the same period. Stuart Butterfield launched Slack around the same era. These were not reckless decisions. They were calculated moves made during a moment when competition was thin, talent was available, office space was cheap, and the world was desperate for new solutions. The recession stripped away the noise and created a rare opening for bold thinkers. Today, those companies are worth billions. The psychology of a recession is equally important to understand. When fear dominates markets, the majority sells at the worst possible time. They lock in losses, move to cash, and wait on the sidelines until the news turns positive again. By the time confidence returns, prices have already recovered. The opportunity is gone. This behavioral pattern, panic, overselling, opportunity, profits, repeats itself in nearly every economic downturn. Those who understand it profit from the predictable irrationality of the crowd. During the COVID-19 pandemic of 2020, the global economy contracted at a speed never seen before. Markets crashed brutally in March, but the pandemic also created an explosive environment for innovation. E-commerce, remote work technology, health tech, and digital entertainment surged. Elon Musk, who already had significant holdings in Tesla and SpaceX, saw his net worth increase dramatically during this period as investors poured money into future-facing companies. Billionaire wealth grew by over $5 trillion during the pandemic years. Not because the world was thriving, but because wealth was being redistributed at an accelerated pace. How ordinary people can use economic cycles to build real wealth. The strategies that create millionaires during economic downturns are not reserved for the wealthy elite. They are accessible to anyone willing to educate themselves, stay disciplined, and act with intention. The first and most important step is preparation. The best time to prepare for a recession is not when it has already arrived. It is during the calm before it. Building a solid emergency fund of at least 3 to 12 months of living expenses is essential. This financial cushion serves two purposes. It protects against income disruption, and it provides the freedom to invest when opportunities appear rather than forcing the sale of assets at the worst moment. The second strategy is consistent investing, regardless of market conditions. A concept known as dollar cost averaging allows an investor to buy fixed amounts of an asset at regular intervals, in both good times and bad. When prices fall during a recession, the same investment amount purchases more shares. When prices recover, the investor benefits from every single unit acquired at the discount. History shows that the average 12-month return following a market drop of 20% or more is close to 24%. Over 5 years, those recoveries have historically exceeded 75% in total returns. The third strategy is identifying recession-resistant sectors and emerging opportunities. Industries like healthcare, utilities, consumer staples, and technology tend to hold up better during downturns because demand for their products and services does not disappear when the economy shrinks. At the same time, every major economic contraction creates a gap in the market, a problem that needs solving in a new way. The entrepreneurs who see that gap first gain an enormous head start. Real estate deserves special mention. During recessions, property values decline, foreclosures rise, and motivated sellers become plentiful. For those who understand real estate fundamentals, this creates acquisition opportunities that can generate decades of passive income. Countless millionaires trace their financial turning point to a single property purchased during a market downturn at a price that would have been unimaginable in good times. The fourth and perhaps most overlooked strategy is investing in skills and knowledge. Recessions often compress job markets, but they also create enormous demand for people who can solve problems, adapt quickly, and deliver results. Those who use economic downturns to build new skills, start side businesses, or deepen their expertise in high-value fields consistently emerge more competitive and more valuable when the recovery arrives. Millionaires are not simply lucky. They are not just born into the right families or handed opportunities without effort. The data tells a very different story. The overwhelming majority of wealthy individuals built their fortunes through deliberate, self-made effort, with a significant portion of that wealth accumulated precisely during the moments everyone else was too afraid to act. Economic cycles are not a threat to be survived. They are a mechanism, a recurring, predictable engine that transfers wealth from the fearful to the prepared, from the reactive to the strategic, from the uninformed to the educated. The cycle will come again. It always does. The only real question is whether the next contraction will take from someone or build for them. That answer is decided long before the headlines ever announce the downturn. It is decided today in the choices made right now.